My friends, welcome to the Heritage Wealth Planning YouTube channel. We're going to talk about investment fallacies 101, and I'm going to share with you a litany of stuff. I got papers after papers after papers. Look at all this. Just stuff that I'm going to go over that I found in my attic that I've been accumulating for years and years and years, and I'm going to go over them with you in various episodes going forward. But I'm going to start with one about investment fallacies. It shares with you some of what some people think. The market should be rational. The market should be efficient, this, that, and the other. And I'm going to shoot that down real quickly. This is an article that came out in 2009 from the American Academy of Financial Management Journal. It doesn't get much more boring than that. The American Academy of Financial Management Journal. And the guy who wrote it was Cliff Short, I think. Cliff Short. And this is a non-technical introduction to Benoit Mandelbrot's multifractal view of financial markets versus modern financial models. Woo, that's a word. But, man, this article right here is, I tell you, is one of the best articles there are. Mandelbrot, he did a book right here. No, I got it back there, The Misbehavior of Markets. Yeah, it's back there someplace. Mandelbrot did a book called The Misbehavior of Markets, Benoit Mandelbrot. And if you're familiar at all with Nassim Nicholas Taleb, he's a big, he actually introduced me to Mandelbrot. And my daughter actually studying math follows, actually likes him quite a bit. So it's very interesting, the mathematics basis of investing and how using statistical analysis can really lead you astray when it comes to your own financial management, your own investment. So I'm just going to share with you a couple of things here. What Charles, I think his name is Charles Short. Let me just real quick, let me just bring back Cliff Short III. Cliff Short III is what his name was. And I looked him up on FINRA in the broker check, and he's not registered anymore. So I don't know what he's doing. I hope he's still in the business. So what he talks about, according to modern financial models of measuring risk, beta, standard deviation, Sharpe ratio, arbitrage pricing theory, and Black-Scholes. All right, this is it's amazing. From 1916 to 2003, basically using standard statistical analysis, there should have been 58 days when the Dow Jones Industrial Average moved more than 3.4%. There was 1,001. Again, this is spring 2009, by the way. So there should have been 58 days according to statistical analysis, where you have the bell curves and whatnot. And it moved 1,001, the Dow did, over 3.4%. There should have been 6 days where the Dow swung beyond 4.5%, and there were 366. Dow swings of 7% or more should come once every 300,000 years. In the 20th century alone, there are 48 days of swings exceeding 7%. And this doesn't even count the 2001 and 2007, 8, and 9. So let me just repeat that. Dow swings of 7% or more, according to modern statistical analysis, a simple bell curve with standard deviations, there should, of 7% or more, should come once every 300,000 years. In the 20th century alone, there are 48 days of the Dow swinging beyond 7%. Again, that doesn't include 2000, from 2000 on. In August 1998, there are 3 trading days where the Dow dropped 3.5%, 4.5%, and 3.5%, 4.4%, and 6.8%. According to our standard models, the 6.8% should happen only one time in 20 million. If you traded every day for 100,000 years, you would not have expected this to happen one time. And yet it happened in August of 1998, and again since, of course. Now, that's just a one time. The odds of those 3 declines happening in any 1 month, again, August of 1998, 3.5, 4.4, and 6.8%. The market was down. The Dow was down. The odds of that happening, any 3 declines happening in any 1 month, are 1 in 500 billion. And I remember this. I had just started working at Vanguard when that happened, basically in August of 2008, I think, or 1998. I remember this, and people are freaking out. In 1997, going back to 7.7%, the Dow fell 7.7% in one day. The odds of that happening are 1 in 50 billion. In July of 2002, the Dow declined sharply within 7 trading days, July of 2002. The odds of that happening are 1 in 4 trillion. On October 19th, 1987, the worst day of trading in over 100 years, the Dow fell 29%. The odds of this happening are 1 in 10 to the 50th power, a number outside the scale of nature. Again, that's from a non-technical introduction to Benoit Mandelbrot's multifractal view of financial markets versus modern financial models in the American Academy of Financial Management Journal, Volume 7, Spring of 2009. So Cliff Short the third, if you're out there, man, I've had this article in this lamination for a long time. Never been able to say it because I worked at a company and now I don't work at a company, so I can say what I want to. And it's just wonderful. Why do I bring this up? Does that mean you shouldn't invest in the markets? No. We have this idea, though, that what happened in the past will happen again. And Frank, I just find that to be silly. It's just simply not statistical evidence. There is not. You'll hear these things called evidence-based investing, modern portfolio theory. Again, the Black-Scholes model on the option pricing, I think that's what it was, and all that stuff. I mean, it's just when things go south, they go south fast, and all the models in the world never predict it. It just doesn't happen. And so the point about this, the number one thing you should do in investing is pay off your debt, because you're basing your investment growth on theories that may or may not come to fruition. Just because the statistical analysis says, oh, there's standard deviation of 2 and that's it. I mean, we have proof that those things blow up in the investment markets. They just do. I mean, just think about it. What happened? The United States was the third largest, best performing stock market in the 20th century, third. So what happens if we became something like China? What happens if we became like Guatemala? Something like that. I'm not even saying we got to be communists or something like that, but what happens if the stock market doesn't go by what would happen in the 20th century? What happens if the market tumbles? What happens? You cannot base your future retirement on this assumption that what happened in the previous century is going to happen again, when we have numbers that show you that does not work. I mean, right here, again, the odds of the Dow falling 7.7% in one day are 1 in 50 billion, but it happened. In August 1998, the market fell 3.5%, 4.4%, and 6.8%. The odds of that happening are 1 in 500 billion, and yet it happened. So all the statistical models in the world aren't going to show that, because the statistical models are this bell curve. We say standard deviation. So we have 1 standard deviation, we have 2 standard deviations, a 3, 4, and so on and so on. If your retirement portfolio is built on the power of this standard deviation, this bell curve, and then we get a thing like in August 1998, and I remember that well, you are going to be in a world of hurt. But what's the one thing you can do different than that? Is pay off your debt. Pay off your debt. You know for a fact, by paying off your debt will increase your rates of return without any risk whatsoever. We don't have to worry about statistical probability. We don't have to worry about Black-Scholes. We don't have to worry about capital asset pricing. I don't even know what the MCAPM, capital asset pricing method. We don't have to with Sharpe ratios, arbitrage pricing theory, risk, beta, standard deviation, alpha. We don't have to worry about all that. Pay off your debt. Pay off your debt. Pay off your debt. Because what we're banking on for your retirement is from the 20th century, may or may not come to fruition. If it doesn't come to fruition and you still have carrying all this debt, you're not going to be able to retire anytime soon. You're just not. And that's bad. So pay off your debt. Wait, I'll put a link in the show notes. I just want to point this out. Just to reiterate, I got a ton of literature here that I've been dying to share with people. Just all kinds of stuff right there that I've been keeping for years and years and years. Just studies and charts and just, oh man. So I'll put a link to Cliff's article in the show notes. Look at it for sure. If you like what you see here, of course, always subscribe. I think it's on that side. Hit subscribe. then hit the bell to be notified for future content, and then hit comments, thumbs up, comments, concerns, all that are welcome. Even down comments, apparently, or down arrows. I don't know why you do that, but hey, whatever. Down arrows help YouTube to say, hey, this is generate traction. So whatever you want to do, I'd appreciate it. Heritage Wealth Planning is a blog, and we'll see you next time on the Heritage Wealth Planning, heritagewealthplanning.com, heritagewealthplanning.com. See you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.